Hello, this is Bill Scheid from Applied Finance Research, and in this video we're going to take a look at backtest results for one of the hybrid systems that we teach in our courses. And I want to start off by saying that the system that we're looking at here is an example of one configuration of the hybrid monthly asset allocation system that I personally trade, but this is by no means the only configuration of the hybrid system, and these are certainly not the only results that are possible. I built this particular configuration to meet my personal trading objectives, but the monthly asset allocation systems we teach are highly flexible and can be easily customized to meet your objectives. So yes, we cover this specific configuration of the system in our course, but more importantly, we teach students how they can modify and build their own configurations. So what we have here is a back test of the hybrid system, one configuration. It does include volatility, stops, and shorts. Those are another option that you can add as you're building your own version of this system. This is a backtest that goes from 2007 to 2023. So it does include the COVID crash, it includes the great financial crisis of 2008, and everything in between. So taking a look at the numbers on the left, we have a comparison between the S&P 500 and this configuration of the hybrid system. So total return for S&P was 323%, hybrid is at 644.3, maximum drawdown minus 52.3 versus minus 14.1. Compounded annual growth rate 9.5% versus 13.7%. Worst period for SPY, so that would be the worst month, was minus 16.5%. Hybrid system had a worst month of minus 6.9%. The return to drawdown ratio for the S&P is 6.2 versus 45.7 for the hybrid, so quite a huge improvement there. The ending balance, this is assuming a hypothetical account that starts with $100,000 and is assumed to grow at the given CAGR for 16 years, so that's 2008 through 2023. Your ending balance, if you had put that money in the S&P 500, would be $427,000. If you put it in a hybrid system, it'd be $780,130. On the right here, we have a year-by-year breakdown of total return and maximum drawdown for both the S&P and the hybrid system. For me personally, I like to look at defense first. Let's talk about how much money we can avoid losing before we talk about how much money we're gonna make. So I like to look at 2008, since that was the year of the great financial crisis. The S&P lost 36.8% that year. The hybrid system made 17.6%. The S&P had a maximum drawdown of 47.6, and the hybrid had a maximum drawdown of 4.4. So outstanding performance in an otherwise terrible year. I also like to look at 2020, since that was the year of the COVID crash. The hybrid system returned 56.3% on a drawdown of only 2.8%. S&P bounced back quite nicely. It did have a drawdown of 33.7%. In fact, this was the fastest drawdown of this magnitude in the history of the stock market. It happened in only 22 days. And the S&P did bounce back. It returned 18.4%. I also like looking at 2022. You may remember during that year, stocks and bonds both had a really tough year. The S&P had a return of negative 18.2%. The hybrid had a small loss, minus 3.9%. The max DD for the S&P was minus 24.5, and the maximum drawdown for the hybrid system was minus 7.3. The other thing I like to look at is number of losing years, and as we see here, the hybrid system made money every single year except for two, when we had a small loss in 2015 and a small loss in 2022. If you'd like more information on this system, please visit us at appliedfinanceresearch.com or click any of the links below this video. Thanks for watching and happy investing.